$5,000 per month in true dividend passive income. Income that comes through the door from dividend stocks that you don't have to work for. It can be used to pay the bills. It can be used to pay for luxuries. It can be used for anything. Who doesn't want that? We all want that. That is the goal. That is the dream. I want to share in the video today exactly how to accomplish this, exactly how to accomplish $5,000 per month or $60,000 per year. And in fact, I'm going to share the answer right now. I get this question all the time. Ian, how much do I need to invest to receive $5,000 per month? Well, if that investor needs the money, needs the cash flow right now, that investor cannot wait at all. Ian, I can't work another day. I need the money now. Well, I'm going to share a scenario today, but the answer is about $700,000. That investor would have to invest $700,000 to receive $5,000 per month, or about $60,000 per year. And that's honestly an investor who has a higher risk tolerance, who's going to go after higher yielding stocks. However, there is a big caveat here. If that same investor can wait, and it's hard to wait. We all know this. We think in our mind, it's so easy to wait. I can do it. I can do another 5 years. I can do another 10 years. But we all know those days are long. The days are really long. And so it's easier said than done. But if the same investor can wait 10 years or maybe even 15 years, that same investor doesn't need $700,000 anymore. That investor needs to deploy $200,000 and just wait. $200,000 deployed now, waiting 10 or so years, maybe a little more, can get that same investor $5,000 per month or $60,000 per year and growing into the future. And so I'm going to share a concept in the video today called dividend yield on cost. The reason the second scenario requires less money is because of dividend yield on cost. And there are four pillars. There are four pillars that are playing at work here. The first one is just kind of time. That investor has more time. The second one is risk tolerance. That investor is taking on a little more risk because, well, in both scenarios, because the investor is going towards higher yielding stocks. The third pillar is dividend reinvestment, and the fourth pillar is dividend growth. I'm going to cover this all in the video today, but I want to start with the easier scenario before I get into the more complex one. So let's say an investor needs $5,000 immediately, right now. How did I come up with this $700,000 dollar investment in the first scenario? In fact, it's oftentimes for most investors even more, because the $700,000 is a higher risk tolerance. But let me show that on the screen. Let me show you some concrete numbers. As you can see on the screen in front of you right now, this is the scenario. This is the first scenario where the investor is just doing a lump sum. And so it really comes down to simple mathematics. You can see the formula. The formula is easy. If you need a certain monthly cash flow, here in this case it's $5,000, I multiply it by 12. So I need $60,000 a year. Then I simply divide by my portfolio average dividend yield. And it tells me how much is required. What's the amount required? How much do I need to deploy? Let's look at a lower risk option. A lower risk option would be SCHD. This is a diversified ETF. And in general, I view it as a lower risk option. So with this particular investment, it's easy. I need $5,000 a month. So $60,000 divided by SCHD's yield. Well, the yield right now is 3.4%. If I divide 60,000 by 3.4%, I get $1.764 million. So a lower risk investor in this first scenario who needs $5,000 per month right now, this investor realistically would need to deploy $1.764 million. And I am sure there are people watching this video that can just do that. This is dividend investing for everyone. It's amazing how many different people I've met on this channel from all different walks of life. And I know there are investors out there watching this channel that can go out and say, okay, I need the $5,000 a month. I have 1.764 million. I'm just going to deploy it. But I would assume the vast majority of people watching probably don't have that amount of capital just sitting there. And so they're thinking, well, how can I get to that $5,000 per month easier, quicker, with less money? How can I do it? And so I have a kind of scenario 1B. This is the same, check it out on the screen. This is the same overarching concept. The concept is, hey, I need the money now. I'm retiring today. And so in this case, in this second example, this kind of scenario 1B, hey, instead of SCHD, what can we do? Well, instead of deploying it in SCHD, I can go for higher yielders. And I'm using an example here, British American, ticker BTI. It's a stock I'm actively buying right now. My patrons already know that. I will link to my Patreon in the pinned comment below. And BTI is yielding 8.4%. And so when the investor puts capital into a higher yielding stock to obtain $5,000 per month, less capital is required. Let's look at the formula. It's the same thing. I need $5,000 a month. I multiply it by 12, so I get $60,000. But now I'm not dividing by 3.4% anymore. I'm dividing by 8.4. And when I divide by 8.4%, I get $714,000 required and change. And so this is how, in the introduction in my video today, I said, hey, for an investor who needs $5,000 a month right now, probably the minimum required is about $700,000. That's how I came up with that number. Now, this is a lot better than the 1.7 million, and so it lowers kind of the bar. It lowers the bar, and I believe it opens up this opportunity to more people watching today. Hey, maybe there are even more people out there, I would assume, who have 700,000 versus 1.7 million. And so that being said, in the next scenario, don't worry, I'm going to share some scenarios where it's possible to obtain this goal with far less money, because we're going to really take advantage of this concept of yield on cost. But first, before I do that, as you can see on the screen, let's just do a simple comparison. So we look at these two scenarios, and worth noting, I'm just picking arbitrary investments. Instead of SCHD, the investor could pick a lot of different high-quality dividend stocks, blend them together. I think 3.4% yield is a lower yield that is really reflective of a more conservative portfolio. Obviously, the person in scenario 1B, kind of this BTI, I'm using BTI as an example, but that investor would generally not want to put $700,000 into one stock. That investor would probably blend a variety of different stocks, MLPs, closed-end funds, covered call ETFs, different high-yielding strategies that would kind of blend out around 8.4. And so that's worth mentioning. I'm not saying here this investor would necessarily put it all in BTI, but BTI is a great proxy for a higher yield strategy. Again, this investor could blend a variety of instruments to obtain 8.4%. So that being said, let's just look at this. What is 714,000 as a percentage of 1.764 million? Well, you can see there it's 40%. So just by taking this one factor of risk tolerance. I talked about 4 pillars at the beginning of the video. I talked about 4 pillars. I talked about risk tolerance. I talked about time. I talked about dividend reinvestment. I talked about dividend growth. We're just talking about one of them here, which is risk tolerance. If that investor who needs the money tomorrow or today goes up the ladder in taking on more risk tolerance, that investor possibly only needs, it's still a lot of money, but 40% as much as that same investor otherwise would have needed. But here's where it gets interesting. I want to talk about a concept of dividend yield on cost. And this is where we not only look at risk tolerance, but we look at time. Time is a huge one. An investor who has more time, and maybe doesn't even have the time, but can kind of make it work. Look, easier said than done. Easier said than done. Sitting around waiting for retirement, for 10 years on end. It sounds in your mind like, oh, I can do that, but it's grueling. We're grinding it out each day, earning active income, converting it to passive income. It's not easy, but it's the game that most of us are playing. And so we're going to put time into the equation now. I also want to put dividend reinvestment into the equation. So because I have time and I'm not going to tap into my dividends right away, I'm going to wait 10 years, I'm going to wait 15 years, I can take the dividends that are paid out, reinvest them back into the same stock or the same basket of stocks to buy more shares. And it creates what's called a dividend snowball effect. I've talked about this in other videos. I'm going to link to this in the pinned comment. I not only have time, I not only have dividend reinvestment, but I have dividend growth. Did you know on average SCHD increases the dividend per year by about 12%? That probably won't happen in perpetuity, but I could foresee it happening for the next, say, 5 years, maybe even 10 years. BTI, slower dividend growth. It's about 2.64%, but it's still growing. And the benefit of BTI is the yield is so high that there's a lot of reinvestment happening there. And so I want to share a model. I'm going to share a spreadsheet. This is what I'm going to do. So I'm on a new social media platform called Blossom Social. It was co-founded by my good friend Brandon Beavis. He's another YouTuber. He's from Canada. He's my favorite Canadian YouTuber by far. He created a social media platform called Blossom. I'm going to include in the pinned comment my affiliate link. If you click my link, I'm compensated when you sign up for Blossom, but it's a free platform. It's free. Anyway, over on Blossom, if you sign up with my link and you follow me, I'm going to be sharing the spreadsheet today. I'm going to share it. So just check me out on Blossom. I look forward to seeing you there. It's an amazing platform. I'm on all the social media platforms. This is one of my favorites though, because the discussion there and the community is kind of second to none. It's amazing. But anyway, I'm going to share it in the video. And so, but check out the pinned comment after the video. But as you can see on the screen in front of you right now, let's go through SCHD first. So SCHD, this is an example of a investment that grows the dividend really quickly, really quickly. And so with SCHD, it's growing the dividend on average by 12% per year. I also bake into my model that capital appreciation is about 7% per year. These are arbitrary. Well, the dividend growth is based on the past 5 years. The capital appreciation, I'm just assuming it's going to be kind of slow and steady capital appreciation. In real life, these models are tough. Well, the BTI one, which I do next, was a little easier. The SCHD one is tough because I don't know if this dividend growth rate will keep up, but it has a good chance of keeping up in this ballpark. But more than anything, I'm trying to prove a point. I'm trying to show a point how time, dividend reinvestment, and dividend growth adds so much. We already know we needed 1.764 million. But did you know if the investor holds SCHD and this dividend growth rate of 12% holds up, all that is needed after 10 years, it's still a lot, is $439,000. So we're talking about going from 1.7 million down to 400,000 and change. Why? Because the investor waited 10 years. What happened during those 10 years? The dividend got reinvested to buy more units of the ETF, and simultaneously, the dividend kept growing each year. The ETF rebalanced itself and reconstituted itself in a way that continued to grow the dividend, and the components of the ETF, many of them were growing the dividend as well. And so again, we're talking about a lower risk scenario here. We're still lower risk because we're talking about SCHD, but just by giving oneself 10 years, it brought the 1.7 million down to the 400,000 range. And as you can see on the screen right now, I don't want this video to go too long. I know the longer videos, they just don't do as well on YouTube. So that's why I'm going to share this over on Blossom. But I just want to explain at a high level what's happening in this spreadsheet. And the whole reason I'm sharing this is over on my Patreon, actually, I just shared like 30 plus spreadsheets. I'm going to link to that in my pinned comment below, but this is just one of the spreadsheets I shared. And I created this actually a variety of years ago, and I repurposed it, I updated it for this video. But I added a new column. Most of the columns here were here from before. It's the last column that's new. And really what it shows in the last column is how much do I need to lump sum invest in year one to obtain $5,000 per month when we look into the future. And I'm assuming I need $5,000 per month. And you can see as the years progress, less money is needed. If you look out to year 15, you only need $189,000 invested in year one to obtain $5,000 per month cash flow in year 15. However, keep in mind with SCHD, realistically, is 12% per year dividend growth rate going to keep up for 15 years? Probably not. And so some of these numbers you have to look at them more as directional. But what's happening in this spreadsheet is a few things. Shares, dividends that are paid are being used to buy more shares. And the dividend each year is growing. So it's this dividend snowball effect. And we have time on our side. And on the risk tolerance standpoint, we pick kind of a lower risk scenario here. But I would say my high level takeaway from this is I think the 400,000 number is probably more around year 15, if you will. So I'm saying by employing yield on cost, by employing this dividend snowball, by waiting 10 to 15 years, I can get my 1.7 million lump sum down to about 400. Now, keep in mind, for sake of simplicity, I'm using a lump sum investment in the video today as the example, but keep in mind that most investors, they're not like that. They're not going to just lump sum 400 grand and then wait 15 years. No, the investor is probably going to lump sum something, but then keep adding like I do. I'm always buying. I bought more stock today. I bought more BTI today. I haven't even had time to update my Patreon yet, but my patrons will see that later. And so here, speaking of BTI, let's do BTI because this is where the magic happens, honestly. This is the magic of dividend stock investing. This is the key. This is yield on cost. This is what I've been talking about on this channel since day one. I'm going to link in the pinned comment below to one of my early videos about yield on cost from so many years ago. And it's just working. It's working in my portfolio. The math, it works on the spreadsheet. It works in reality. I'd say the only disparity between spreadsheet and reality is I think most of us overestimate the dividend growth rates. And they are not necessarily going to hold up because I'm looking at the past. I'm looking at the past 5 years of growth rates for SCHD. I don't know if the dividend will continue to grow like that in the next 5 years. But this is why I'm so excited about BTI because I don't really need the dividend to grow too much on this one. I'm relying more on reinvesting. With SCHD, I'm relying on dividend growth rate. BTI, it's already paying a high dividend. The dividend growth rate, it's only 2.6% per year, and I know they'll keep that up, or I think they will at least. But check it out. I have the same spreadsheet here, but with BTI. And so what we're seeing with BTI on this spreadsheet is it yields 2.6. I'm assuming the capital appreciation will be about 6% per year. The reason capital appreciation is important in this model is with reinvesting, I'm assuming that the reinvesting happens at higher share prices. The higher you put the capital appreciation, the more realistic, the more conservative the model will look, which is good. But with BTI, what's so different with BTI than with SCHD is I don't need the dividend growth really to happen as much. I think 2.6 is pretty darn reasonable. What is really happening here, and of course it doesn't take taxes into account, so that's another caveat with the video today. For sake of simplicity, I'm not looking at taxes, although dividends being reinvested are generally pretty tax efficient. But check it out. In year one, we all know, hey, we need $700,000 or so invested to get that $5,000 per month. If I'm willing to wait till year 10 and I just reinvest the dividends, I rely on the dividend growth rate, I rely on having more time. This is a model, of course, that's higher risk. It's higher risk tolerance because we're dealing with higher yielders. I can get to about only $296,000, so just under $300,000 invested. And if I can wait to year 15, I can get $200,000 lump sum right now. Again, the way to read this is if I put in $200,000 right now in year one, I wait 15 years, I do nothing else other than reinvest my dividends, and I grind it away at a job for 15 years. Hypothetically, based on the model, I will be yielding $5,000 per month in 15 years. Now that also doesn't account for inflation. It's the $5,000 in 15 years will be worth less than $5,000 today. But again, this is a directional model. This is meant to inspire. This is meant to help just understand how this all works. And it's meant to show the value of waiting, of patience, of time, of the different levers in this dividend snowball. Now, what I will say about the BTI example on the screen right now is this one, in my opinion, is more realistic because I'm not relying on dividend growth. I'm really relying on just the dividend it pays now. And they can already cover the dividend now. It's not a problem. The company is doing just fine. And so I would say this model honestly may be even more realistic than the SCHD one. But the takeaway here is instead of investing $700,000, if I'm willing to grind it away at work for 15 more years, I could just invest $200,000 now, wait it out, and achieve my goal. Now, worth noting, the concept that comes into play is yield on cost. And what I'm showing right here is true yield on cost. You can see in the column there, second to last, this is probably the most important column. It shows in year one right now the yield on BTI is 8.42. But because I'm reinvesting, because the dividend is growing over time, the yield on cost, which is defined as the dividend income divided by my original purchase price, it goes up. And it goes up a lot. And because I'm locking in shares right now at $35 and change, but my dividends keep going up because of reinvestment and because of dividend growth, my yield on cost goes up. And if I can make it to year 15, I'm projecting 30% yield on cost. That's how it works. That's the magic. That's why less money is needed. Why is less money needed when we wait? Because the dividend snowball creates true yield on cost. And I'm not getting an 8.42. 8.42 is already great. But no, in year 15, I'm at a 30% yield on cost, hypothetically, based on the modeling. And again, I can't stress enough how this is just modeling. This is just directional. It's not set in stone. It probably will not play out this way, but it is meant to inspire. It is meant to illustrate a point. And why so many investors, they don't do dividend investing. They go away from dividend investing because they just look at the numbers and they're like, okay, I need 1.7 million now. I can't do that. Or I need 700,000 now. I can't do that. So many investors tell themselves, I can't do that. And because of that, they leave the strategy. They go do growth stocks. They try to do riskier strategies. They try to multiply their money 10 times over in riskier strategies, but they don't realize yield on cost. Yield on cost takes my requirement down all the way to 200 to 400,000 range with patience. And that may sound like a lot of money, and it is a lot of money, especially for a lump sum. But think about it. Could you over the next, say, 1 to 5 years, save and invest $200,000? It's a lot of money, but it's possible. And then if you do that, could you wait another 10 to 15 years to get your $5,000 a month? It's painful. It's grinding it out for active income, but could you do that? Yes, it's possible. Dividend investing, it is not easy. It is hard work, but it is possible. And that's really the message I want to convey today. To summarize all of this, as you can see on the screen right now, check it out. So basically, again, this is the example where we're waiting 10 or so years. And with SCHD, basically the lump sum required now comes down to about 400,000 range because I'm getting up to a 13.66% true yield on cost. This shows the power of dividend growth. The example with BTI, assuming a 2.6% compound annual growth rate, my lump sum required now goes all the way down from 700,000 to the 300,000 range. That's because after 10 years, I can get a 20% yield on cost. If I go to year 15, I get a 30% yield on cost. This example shows why reinvestment matters so much. And so obviously, I threw a lot at you today. I'm going very quick. I think it's going to take time if you're newer to these concepts to learn them. And that's why I encourage you in the pinned comment below, click the link for my affiliate link. In terms of full disclosure, I'm a Blossom affiliate and I get compensated for signups, but it is a free platform. I'm going to share the spreadsheet over there. I already have this spreadsheet shared with my patrons, by the way. I'll also link to that in the pinned comment below. But check out the spreadsheet to see how it works. And again, I want to summarize. It's not easy. It takes time. And it's painful. It requires a huge savings rate, a lot of dedication, a lot of patience, but it's possible. It's possible to obtain $5,000 per month. And the levers that make it happen and all of these levers can make it happen faster if they're used kind of in certain ways, are risk tolerance. The next one is time. The next one is dividend reinvestment. The last one is dividend growth. All of these put together are the key to dividend stock investing. Thank you for watching today. If you enjoyed the video, please click the like button. It means the world to me. And please don't forget to subscribe to my channel. I have new videos here all the time. In terms of full disclosure, I am long SCHD. I am also long British American, ticker BTI. I own those in my personal dividend stock portfolio. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my personal journey, and it's possible to lose money in the stock market. Also, as mentioned in the video, these models are not an exact science. It is directional in nature, meant to illustrate a point. It's most likely that these scenarios will not play out like this in the real world. There's going to be some differences in how we see it play out because we can't predict the future. In terms of a friendly disclaimer, I am not a licensed tax advisor and I don't offer any tax advice. Thank you for watching the video. I can't wait to see you in the comments below, and I will see you in the next dividend stock investing video.